Numo, and today I have with us Roi Tavor, the founder and CEO of Numo. Welcome, Roi.
Hi, Effie.
We're both in Switzerland. We're both homebound, of course. I have the privilege of switching backgrounds on Zoom every day as I try to talk to more people. And Roi has been running and being in an intense period with what's going on in the markets. So Roi, tell us first of all about Numo. What is Numo and what keeps you up at night these days? What's going on? Give us a pulse from the current market conditions.
Well, Numo is a personal financial management platform that allows our users to manage, maintain, and improve their financial health. So everything we do at Numo is geared towards supporting our customers in making sure that they are well prepared in their financial lives currently, but also for the future. And the main offering of Numo is really to enable our users to connect all of their financial accounts, credit cards, bank accounts, mortgages, student loans, but also investments. Whether you have a brokerage account or a Roth IRA, a 401k, you can connect everything in one place, because we believe that if you want to improve your financial health, your financial wellness, you need to have transparency and a full overview of what your money is actually doing. So that's a key offering. Ultimately, we believe that the future, when we talk about financial services, lies in open banking in marketplaces. We just closed a deal with Visa to offer our customers specific benefits geared towards their behavior. So obviously we understand our consumers very, very well because we know their preferences, their behaviors from a day-to-day perspective, and we can now offer them special discounts, benefits from hundreds of merchants throughout the US. Numo is today only available in the US for several reasons, but we're planning to also enter the European and the Swiss market.
Very interesting. And for our audience that doesn't know, Roi is based here in Switzerland, in Zurich. And Numo published recently, and when I say recently, pre-bear market or pre-crash period, a very comprehensive report looking at over 20, I believe, Robo-Advisors globally and their 2019 performance. I assume this is, Roi, within the context of offering transparency to customers and potential customers in terms of actual performance, correct?
Yes, absolutely. So, in line with our ambition and our vision to help people improving their financial situation, obviously investing is a crucial element. So obviously you can spend less and save money in a savings account and so forth. But if you really want to grow more substantially your financial situation over a longer period of time, investing is key. And for a vast majority of people, digital solutions will drive the wealth management space. And we do not offer a Robo-Advisor service or a discretionary portfolio. Rather, we compare them on Nummo.com, and every 6 months or so, we release a Robo-ranking report. And the one we did was a full year performance comparison. We typically split the portfolios into the 5 main asset categories from income, conservative, balanced, growth, and value. And we compare full year performance. And this we do with the support of Morningstar. And I think what was interesting, and I think that is key, most people in the US don't understand enough about finances. And that's why Robo-Advisor services are so ideal for people who do not have the understanding nor the time or the interest to get too deeply involved in investments. Nevertheless, our aim when we're publishing those figures, and we're the only one in the world really doing that transparency work, is to show that there are major differences. If you read our report, while we review about 300 actual portfolios, we only publish the top 3 portfolios and the bottom 3. And the reason we do that is that it doesn't really matter whether, 1 year there's a firm that performs 1% or 1.5% better than another. What we want to show is that there are vast differences between the top and the bottom per asset category. And that is the reason why it's so hugely important to review your portfolio periodically. So we are not advertising for a daily check on your portfolio, but once every 3 months, once every 6 months, you should review your portfolio to make sure it is still in line with your expectation and compared to some of the competition with respect to
Roy, I was
portfolios.
having a discussion with another colleague in the US that is specialized in the ETF business, and we were talking about the same point in ETFs, meaning you have an ETF that tracks an investment theme, for example, exposure to robotics or some sector. But what financial advisors need to realize, and investors, is that there are huge differences between ETFs that are tracking the same either theme or sector. And investors need to understand that. It's the same with robo-advisors.
Yes.
I mean, I saw from your report that you have a broad range of robo-advisors that you've reviewed, from the incumbents like Charles Schwab and Morgan Stanley to the first sort of innovators like Betterment and Wealthfront, and then all the other variety that's also hybrid in terms of, either having a hybrid human robo-advisor or being more on the saving side. There's all sorts of numbers there. What struck me when I reviewed your report was that if I am just really naive and say, okay, let me see which bucket did better of all from the categories, right, the model portfolios, I noticed that the value ones did the best. We're talking about high returns in the 40s, which I didn't expect. And some of them are in the sustainable category. And I know you don't have the report in front of you, but that really struck me as a very interesting. I was looking, these are the value portfolios, of course, with allocation 100% to equities and stash and aspiration. With sustainable investing strategies, they've returned 37 to 43%.
Yes.
It is because the trend from last year, I don't know, but it actually struck me as something, because we all think that value has not worked and growth has worked in the past.
Yes. No, I think what we saw in the results, the value category was definitely an outlier. So when it came to the balanced portfolios, you saw closer ranges. With the value portfolios, the difference between the top performers and the bottom performers were the biggest. So stash, I think, was 43%, was definitely an excellent performance. overall, you could expect it because they have theoretically the highest exposure to equities. And last year, S&P Dow performed extremely well. So, but most of the value portfolios came in somewhere between 20-25%. Those two that you mentioned performed extremely well.
Extremely well.
Yes. But here I also, if I may, I want to highlight maybe a trend. So if there were two robo-advisors who consistently performed very well throughout all the categories, it was Wealthfront and TIAA. Those two firms did exceptionally well and should be commended because it was not just one portfolio that did well. They got top spots in basically all of the categories, and they did very well. And on the bottom side, you know that JP Morgan started with their Robo-Advisor offering earlier last year. They had a difficult time. So they need to get a little bit more into the routine of providing the service. Their performance results weren't great.
Right. Let's talk about rebalancing. And of course, you don't have any numbers, but what do you think has happened over the past month with these extremely abrupt moves in markets, even dislocations in ETFs, especially in bond ETFs? We've had just unique dislocations because of the illiquidity of the underlying assets and all sorts of other issues in the market. I mean, ETFs are obviously the bread and butter of Robo-Advisors, and here we have huge issues in the market. What do you think has been happening with the rebalancing? Could you share with us what are the main ways that most robo-advisors rebalance portfolios? Is it the naive way of plus minus 5% moves? How does it work?
Yeah. So let me maybe first say something about user behavior, because those are the things that we actually see quite clearly. There are two trends right now. The one trend is for people who have not been invested to open accounts with robo-advisors right now, provided that they do have some liquidity, because they see it as an opportunity to enter the market given this corona outbreak. Now, at the same time, we see closures, and this will continue as this recession in which we are currently will intensify. And the closures relate to people. Remember, the average robo-advisor portfolio deposit is small. We're talking about $500, $1,000, maybe $5,000. The closures will come from people who over time invested, but because of the crisis right now, need liquidity. So a lot of people, yesterday I read unemployment is assumed to jump between 1 to 4 million people in the US. Yeah. Those people who have extra liquidity within their investments, they will draw this down to survive over the next 3 to 6 months. So those are two general trends.
Roy, I'm going to interrupt you because we have jobless claims this afternoon, like at 1:30 our time here. I was reading this morning, the US workforce is 160 million people. And if we get a number around 2 or 3 million of unemployed, this is what is expected, and we might get to worse numbers. So this is huge, right?
Huge. Absolutely huge. And that's why you will see drawdowns from robo-advisors, but also traditional investment advisors who will be faced with current liquidity needs of customers who need to survive. So those are general trends. Now, in terms of rebalancing, I think one thing to remember is unless you are a savvy, an avid or a savvy investor, don't try to rebalance or play the market yourself right now. It's extremely difficult, and even professionals struggle. What we don't expect is massive shifts. When we compare results, 2017, 2018, 2019, the rebalancing of the actual portfolios are minor. They are not huge, because if you are in a value category, you need to remain within those parameters. If you are within an income or a conservative mandate, you need to maintain those parameters. Obviously, you can reduce some of the equity exposure, but I don't expect that there is a huge move, especially in the growth and value category, towards cash, for example. And then maybe just to mention the bonds, which you mentioned before, if 3 weeks ago you did shift into the treasury bill market, you might have profited. But right now, it has narrowed so much. Yesterday, I'm sure you have seen it, the 1 month and 3 months treasury bills went into negative territory.
So we have a huge steepening of the curve, right?
Exactly. So it's going to be extremely difficult. And I think most of the portfolios will stay the course and rebalance, but minimally.
Okay. I mean, I'm thinking what the numbers are going to be, both in the ETF market. I have a figure on my head. Year-end 2019, the global ETF market was about 5.4 trillion. I'd like to see those figures, by the end of Q1, and see where we are at and how, the net outflows have damaged that market. And then, of course, to see what's happening with the Robo-Advisory market, because it will be hit from outflows and from underperformance, obviously,
yes.
Right?
Yes. Maybe to just again give the perspective from a consumer point of view. So when you go to Nummo.com, you can actually see on a portfolio level the 52-week performance, and I just checked it earlier this morning. So most of the portfolios, if you look at the 1 year performance, while there are losses, the losses are obviously not as substantial as what we have witnessed the last 2 weeks. So, and I think this is what is calming also investors to a certain extent, especially if you have money in a 401k, to just more stay the course rather than do something, harshly.
Correct. So just to wrap up and close, Roy, in terms of what Numo offers for the investing side, tell us a little bit more. Is it individual stocks? Are you collaborating with the service?
Yes.
How is investing on Numo?
So we believe that there's a lot of people out there who know a lot about investing. We don't want to compete with managers out there. We try to help them by offering transparency. So we don't give actual investment advice. We just demonstrate what's happening in the market, and we try to educate as far as we can what the options are of consumers, be in traditional investing or in a retirement setting. Obviously, when you open a Nummo account, we do have special features and tools with respect to, for example, retirement calculation. So very simple. You can put in all of your assets, all of your debt, and your expected needs for when you retire, and you will see certain modeling on how you need to invest in general to reach those goals. So we have certain goals, features, investment features, but we don't provide actual investment advice.
Okay, but users, customers can link with their Wealthfront account, their Charles
Yes,
Schwab account,
absolutely. Absolutely.
and so on, and so on.
Yes.
So lastly, I want to ask you about the behavioral side that you have seen as a personal financial management service. What has struck you during this period from the data that you see from your customers on Numo, if there's anything that you can share right now?
Yeah, I think, the biggest and saddest element is really the pain and the suffering. And this, we get comments, we get emails from users. They don't know how to survive. And remember, about 75% of people in the US live paycheck to paycheck. Much of the community that is using Numo falls in that category. And this is something that will continue. So even though the markets, the last 2 days have bounced back, the depth of this recession is not felt yet. And that is the case for Europe, for Switzerland, for the US. And this is something that I think we all need to prepare ourselves because it's going to hit all of us very, very hard.
Understood. So at the end of the day, it's you see the personal suffering really, and I guess this is the stock market and all the other indicators are lagging, but you see the crowd really understanding what the impact is going to be on the real economy.
Yes, exactly. I mean, this is what we see. This is what we're here for. Also, I think everybody needs to understand that the stock market somehow is disconnected from the regular people, from all of us, just because investment managers need to invest. And right now, the bond market is so squeezed, and a lot of people cannot just stay in cash, so they need to invest. And for the past 10 years, that only alternative was the equity market, and this is what we see. So obviously the stimulus bills are helping, but the underlying suffering will be much harder and more prolonged than what I think many people in the investment world believe right now.
And Roy, I want to close with a thought that I've had that, in this crisis and talking to you, it's again clear that everything's connected. So, our personal financial management of our budget and so on, our investing, I guess our insurance, everything is connected. And in this crisis situation, we feel it, right? Because everything is affected, and we have to take a look holistically at our assets, tangible
Correct.
and intangible, and figure out how to manage them. Even a credit score in this situation is an asset that needs
Yes.
to be managed in the right way, whether it's optimizing it or reducing risk and so on. So on that note, I want to thank you for sharing your insights today.
Thank you very much, Effie. It has been a pleasure, and stay safe.